team of the evening, our second team from the Boulder, the Sharks. Welcome on stage, grab a microphone and turn it on.
Well, and you are so tall.
I know. I'm sorry.
So that's fine. That's fine. I can see.
Good afternoon, and thank you for being here today. My name is Ethan Rising. This is Cole, Armin, Eric, and Adrija, and today we're going to be discussing our bail valuation model. Our recommendation is hold, and our analysis was conducted at a price of $2.89 per share. Some of our key metrics that we found were the dividend and betas. So, Vail Mountain Resorts is the premier operator in the ski and mountain resort industries globally. They currently operate in 37 different markets and regions. Their revenues are driven from three main divisions. They're driven from the mountain division, lodging division, and the real estate division. The mountain division consists of 89% of Vail's revenues in 2021. This division is comprised of the ski pass revenues and the on-mountain dining revenues for Vail. Our analysis concluded that this division represents a big risk to Vail, as with their ski pass revenue, they're currently exposed to a great deal of service recommendation risks. The lodging revenues comprise 11% of Vail's overall total revenue in 2021, and our analysis concluded that there was a great opportunity within the lodging sector, as these assets remain operational and cash driving far outside of the traditional confines of the ski season. We would like to see management focus on driving these revenues up further coming in the future. And finally, we have the real estate division. In the real estate division, no profits are currently driven, but an ancillary benefit is recognized from the depreciation expenses on their assets, and this improves their net income overall. Within the market segment, Vail Mountain Resorts currently controls the majority of the market, has market dominance, but their main competitor is Alterra, while they also compete with Boeing. Alterra recently increased their salaries across the board by $3. With Vail already increasing labor expenses by 33% year over year, their ability to continue to increase these metrics is heavily constrained and could place downward pressures on their profits.
Yeah, I'll be taking revenue financial analysis. Revenue analysis first. The next slide. Towards the end of 2021, we can see.
Whoa. What happened? I'm so sorry, guys. Continue.
Yeah, towards the end of 2021, we can see Vail acquisitions continuing with the acquisition of 7 spring resorts, adding new sets of assets and liabilities to their balance sheets. Positive but a slower EBITDA growth can also be seen from the graphs, as you can see, which is driven mostly by the sales of heavily priced Epic passes versus the previous years. They also recently announced a 2022 capital plan amounting of $350 to $325 million, consisting of upgrading ski facilities at various locations. Next slide. Margin analysis. It is a low margin business, as you can probably see by the net income margin right at the bottom there, around 5% towards the 2020 where we go to 2020, and that will be seen. This is because they missed their also from 2019. There's a big drop from 2019 to 2020 because they had deferred their Epic Pass revenue recognition, which could have seen 2020 levels to go even lower. But but they also apparently they're doing better than their peers, as you can see the peer comparison there. Next slide, please. And for the profitability, we can see similar trends for ROE and ROIC, which do not, and the peer comparison doesn't look any convincing either. The one-time plan also aims at high profitability margins for the 2022 and 2023 season. Some of these plans include investing heavily in technology, guest experience enhancements like train expansion at Keystone, building new lifts at Breckenridge, and also building new quantum lifts at Okemo Resorts. Next one, and on to CapEx and debt growth APIs. This is pretty interesting. Majority of the business units had to be kept operational during the COVID time, which is significantly expensive for a ski resort, and that might also explain their insider selling as suggested by their recent 10Ks. Operating cash can be seen to cover the debt pretty well on the balance sheets, but the interest coverage rates shown are showing warning signs. As it now well covered by the EBIT values, which stand at 1.8x compared to 3x for the company standards. Industry standards for leisure and consumer discretionary industry. Moving on to valuation now. As you can probably see on the screen right now, we consider standard valuation multiples here and have a stock price listed accordingly. Besides them, we can see a price of $290, which we strictly consider cash healthy for of Whale over 5-year average, and that's why we value Whale's resort at $290 per stock. Another interesting inference here is a significant chunk of EBIT earnings going towards depreciation and amortization, hence they have like high debt rate, high leverage, can be inferred from there. This could have led to falling of EPS to over -$3, which was recently released for 2022 quarter one announcements, which restricts the stock price to 264 when we compare from the PE ratios of the industry standards. The data also indicates that Whale resorts might be overvalued, stock price might be overvalued as suggested by EBITDA multiple, which is at 3x compared to the industry standards, and we've also listed some of the competition which we could find public information on. On to Cole now.
Thank you, Harman. So let's move on to the sensitivity analysis. For our sensitivity analysis, we changed two major variables, terminal growth and weighted average cost of capital. Based off of our sensitivity analysis, we found that 290 was a accurate assessment of Vail Resorts' fair market value. If you look at the terminal growth up here at the top, we see that the WACC is a little higher than the industry standard, and this is a detriment to Vail Resorts because it greater discounts their future cash flows, leading to a smaller stock price today. Moving on to the Monte Carlo. Based off our Monte Carlo simulation on the revenue, we found that their stock prices should be between $272 and $360, with 272 at above 25% and 306 outperforming 75% of the model. This leads the stock price to be fairly priced at 290. Moving on to risk analysis with Adrija.
Okay, so Whale has mainly financial risk and operational risk. So in financial risk, we noticed that since Whale has approximately 900 million due in by 2024, it might have to refinance its loans in the upcoming years. Next, due to seasonality and the current depressed economic conditions, Whale will also face revenue volatility. Finally, due to its aggressive M&A strategies, Whale also faces might also face problems in integrating its newly acquired businesses to its Whale brand image. Moving on to operational risks, Whale's, due to decreasing annual snowfall, Whale also faces a risk of having lower number of skiers per year. Furthermore, due to the economic crisis caused by the COVID pandemic, Whale also has a chance of not recovering its revenue until 2024. Whale's main operational risk comes from its staffing issues, which is caused mainly due to mismanagement and the current wage crisis. We have also identified some secondary risks for Whale, but we predict that they will have low impact and will not have any or too much, any too less impact in the upcoming years. Moving on to ESG by Eric.
Thank you, Idrija. The two main environmental risks are the snow plowing that negatively impacts the alpine vegetation of the mountains that it plows upon. It literally makes it so the alpine vegetation is unable to grow back once plowed upon. Secondly, the actual creation process of artificial snow negatively impacts the immediate ecosystem because it takes up a lot of water and a lot of energy to create. And then, as I'm sure you guys are aware, Vail in 2017 unveiled an initiative called the Epic Promise for Zero Footprint, where it promised zero net emissions within 2030. Overall, these are our, in terms of social, in terms of social, in 2021, Vail's then CEO Rob Katz sent out an email to his employees called "We Are Part of the Problem," where he addressed the lack of diversity within the ski industry and within Vail Resorts. And in that email, he he launched a few initiatives, a few strategies, and a few programs to increase the overall diversity within Vail and the overall industry. And as I'm sure you guys are aware again, Vail appointed a new CEO in 2021, Kirsten Lynch, and Vail's overall ESG score, according to the Institutional Shareholder Services Organization, was 1, meaning that it did not pose a viable risk in terms of its overall valuation.
Perfect. Well, with that, we're going to reiterate our whole position that we've been stating throughout this whole presentation. We think that 290 is a fair assessment of Vail Resorts' current stock valuation. Thank you very much.
All right, we have 10 minutes for Q&A.
So I'll start it off on the valuation page. Just a question I had about the slide itself was, I was a little confused why Newell and Tapestry were the two comps that you guys use, or maybe I'm misunderstanding that, but.
No. So those were the ones on which those were the firms on which the most public data was available according to Bloomberg.
Yep.
So that's why we included that, and Wind Resorts because it's a resort. So yes, that's why.
Got it. Thank you.
Yeah, there wasn't much information available on Altera, which was mentioned in the earlier slides. I think it's a privately held firm, so that's why we couldn't find a lot of information. That's why, yeah.
Okay.
And then to take it further for Armin right here, for my colleague. Altera is a privately owned company by the Crown family. They're operated out of Aspen, and their current main asset is the Aspen Ski Co Foundation. This industry is actually funded largely in terms of hubris, the same thing that drives mergers and acquisitions. The Crown family has the ability to drive revenues and increase profits for Vail, as their Aspen Valley Ski Co assets drive a greater increase in profit than Vail does on a mountain basis. Also, there was the option to include hotel chain of hotels, but according to Bloomberg, they didn't have enough data, so we didn't see it fit for our comparison.
Okay, thanks. That's helpful.
I have two questions for you guys.
Of course.
The first question has to do with the likelihood of the company going under. The solvency risk is one. Number two, is it likely that the company could become a buyout target by another larger company?
So it is a possibility that Vail Mountain Resorts, there is a possibility that Vail Mountain Resorts does become a target for a buyout, but their current metrics would have to decrease significantly. The main person who could actually even be a viable target to acquire them would be Marriott Resorts, who's also recently entered the ski areas by acquiring assets both in Aspen Valley, in the Adirondacks, and in Utah, specifically with the Park Utah St. Regis asset acquisition through the Marriott Starwood merger.
And how large is that, how large is that other company?
Marriott is the market leader currently. Its valuation, I believe, is roughly, somewhere between 40 and 100 billion.
So is there anything going on currently between Marriott and Vail Resorts?
Currently, there's nothing that is public knowledge between Vail and Marriott Resorts. I mean, certainly something could be happening behind the scenes, but it hasn't been made public yet. What Marriott has been doing is they've been in talks with a company called Haymax Hotels. They've been acquiring assets across the board, both the Molly Gibson and the Aspen Valley Lodge, which have just been knocked down, and they're going to be rebuilt using a $20 million allocation budget. So they are in talks and they're moving in. Arnie Sorensen, the CEO of Marriott, is a great believer and a great advocate of ski resorts and ski towns, and so it'll be interesting to see how Marriott continues to behave in the future. But given their market dominance position, it would be very hard for them to continue acquiring things after the Starwood merger, as they're entering a monopoly or oligarchy territory.
And what is their default risk?
Marriott or Vail Resorts? Vail Resorts. So our default risk on Vail, even though they have an increased leverage profile, is very low, because they've recently issued bonds in 2020, April, for $600 million, increasing their total asset value from $600 million to $1.2 billion in terms of their working capital and available assets to pay for returns.
Are the ratings under possible downgrade?
Sorry, what?
Are the ratings potential downgrade by anyone?
I personally believe that Vail is at a risk for potential downgrade, given that their leverage profile is more than double that of the industry average. It'd be hard to see how some bank or credit agencies would decrease their credit rating, increasing their cost of capital at some point.
But apparently when I was going through the credit ratings, it seemed to be in tandem with the industry average, so I don't think so just yet.
Thank you.
Yeah.
You talked about a wage or something, you mentioned a wage crisis. Is Vail kind of a taker of the market in terms of labor, or is there something they can do fundamentally to change their labor and wage equation without trashing the margins?
So there is a lot of possibility for Vail to improve their margins, but currently with a year-over-year increase of 33%, it would require an instrumental management top-down approach in order to improve those metrics, especially given that most of their focus has been on increasing the volume sales for their main driver, which is ski passes. Guest service is going to be one of the really main focuses that I would like to see them focus on, as an increase in their guest loading infrastructure on the mountain could really decrease their risk of losing customers in the future, as there has been a lot of articles published from people, especially angry individuals. One in particular that sticks in my mind is that there was a lawsuit filed against Vail in relationship with their dismissal of a parking lot that was supposed to be made available for free to all pass holders, and then it was turned to a for-profit parking lot, and they had to go back and change it after the lawsuit.
Is there anything that they can do themselves to raise wages? Obviously, that impacts their margins. Anything else?
Yeah, well, obviously if you raise the price of the seasonal passes, that will lead to them having more wiggle room when talking about wage increases.
As we just want to add on that, we've already seen that they increased the passes for this season, and they saw the growth, but it was lower than expected compared to previous years. So they tried that. I mean, they're still getting the margins, but for how long, that's the question. So, yeah.
Yeah, there you go.
So just to follow on to Kathy's questions also, is there any initiative in Vail to maybe do non-salary oriented things to help bring in, more talent, such as affordable housing, build out derricks or whatnot for seasonal staff?
I haven't actually seen anything.
There's probably already accommodations for seasonal stuff, as long as I can remember, I read it. But yeah, they can expand on their real estate segment and build more such occupations for seasonal workers. But the thing is, like, it's so competitive out there between Altera, if you compare, or Vail, that even though hourly wages are competitive. So, and also this thing is like, it's seasonal. So not a lot of people are like encouraged by the idea of working at Vail or like any other ski resort. Like after a certain time, probably beyond 2020 or 22, 23, that's when the people actually go out and explore more opportunities. That's what I read according to a report by Bloomberg. And yes, so it's kind of difficult to pull more workforce towards ski resorts or leisure resorts in general. I think so. So yeah.
Vail does have affordable housing though. Affordable housing has traditionally been a great challenge for all companies operating in ski resorts, as the cost of real estate is traditionally far above that of the average. And these are in areas that are geographically restricted by the mountains that are in the ranges. I don't know if any of our people here have actually been up to Vail or Aspen before, Utah or the Adirondacks, but these valleys are restricted by the mountains. The cost to build would be significant. And so in terms of Vail, they've actually been acquiring affordable housing in the city of Gypsum, which is more than an hour away from Vail, and they've been allocating employees down to there, which has actually disenfranchised a lot of their employees, placing another downward concern on their employment levels.
Did it answer your question? In a way.
All right, okay. Perfect.
Last question.
All right, let's hear it.
What would you like to see in your Q2 or Q3 earnings release? What kind of trend information would you like to see that would cause you to change your rating to something more positive?
Yeah, obviously growth is going to be a key factor in our Q2 to Q3 areas. That is when most of their pass sales happen during the year. So pass sales obviously directly integrate with how many people are going to be coming into the mountain during the ski season. So if in Q2 to Q3 we see increased growth sales and passes, that is a very positive indication for that Vail is going to be in a good position come ski season next year.
Just to add on that, most of Vail's revenue from quarter 1, quarter 2, if I'm not wrong, it comes from the Australia resorts, or whatever resorts are in Australia, and there are heavy COVID restrictions there for now, so it might be lower than expected, the revenue growth. So I don't know if we actually see an uptick in the revenue growth. So yeah.
Eric, got anything to add to this?
Yeah, I think growth is the key thing. Even the growth, I mean, obviously with the COVID-19 pandemic, there is a lot of room to grow. So, EPS growth, EBITDA growth, I think just, any form of growth is a positive indication. Would, potentially shift our overall position, our overall hold position, and maybe potentially turn into buy.
And also reduce their also reduce their exposure to debt level, because they have enormous debt levels compared to the industry. So that could be advantageous, but I don't know how they'll do that. So yeah, thank you.
Yeah, thank you so much.